Well, in this video, I want to talk about the 7 step trading process that I follow, that I have been following, but I have now crystallized it to 7 particular steps, which you see on the screen. So, the first step is comparisons. I will discuss this further in the video. Comparisons means I am looking at the current situation of the stock. How is the stock doing compared to the other stocks in the market, or how is the stock doing compared to the index, or how is the stock doing compared to other stocks in the same group. Okay, I want to see the current position of the stock. That's what I mean by comparisons, and we will dig deeper into this topic today. Next is technicals. Once I am done with the comparisons, I want to see technically how the stock is set up. In each of these 7 steps, I ask 3 questions basically, or there are 3 considerations in each of these 7 steps. And in this video, we will look at the 3 conditions for each of these steps. So, first, I will look at the comparisons, then, I will look at the technicals of the stock, then, I will look at the fundamentals of the stock. After I complete this, I am ready to buy the stock. But buying the stock doesn't mean that my decision making is over. I have to decide what position size I want to take. Do I put 5% in the stock, or 25% in the stock, or some other odd number? Okay. Even that is not enough. Once I decide that I want to take this much position, I want to know when I'm going to get out of the stock before I know when I'm going to, hold on to the stock. So, for example, if I want to buy a stock at $100, assuming I'm trading the US market, if I want to buy a stock at $100, I have to know before I put the trade where my stop loss is going to be. Okay, 7%, 8%, whatever it is. I need to know before I take the trade what my maximum risk is going to be. Otherwise, I'm not taking the trade. So, position sizing, risk management. Then comes trade execution. See, in the first 5 steps, you are still not involved with the stock, because you are still doing analysis, you are still making a plan with position sizing, risk management. Trade execution is where actually you put money at stake. Okay, and once you put money at stake, then comes trade management. So these are the 7 steps, and we will discuss 3 questions for each steps, the 3 key questions to ask at each step. So comparisons, technicals, fundamentals, position sizing, risk management, trade execution, and trade management. So let us look at these 7 steps one by one. So comparisons. Whatever stock I am planning to buy, first I will compare that stock with the general market index. So if I am trading the US market, I would like to see how is my stock doing compared to the S&P 500. Or if I am trading the Indian market, I would like to see how is my stock doing compared to the Nifty 50. So I want my stock to be stronger than the index. Otherwise, it just makes sense to just put the money in the index. Why would I put my money in a stock to take more risk? So first comparison is, I want to compare my stock with the general market index and see whether my stock is doing well or not compared to the index. The second comparison is all stocks. So there are 5,000 stocks in the Indian market, for example. So I will compare my stock with all the remaining 4,999 stocks and see how is my stock doing compared to the entire stock market. So let's say my stock has performed better than 89% of all the stocks in the stock market in the past 1 year. That's a sign of strength, right? So there I get a understanding of whether my stock is strong or not. Then group stocks. See, every stock belongs to an industry group. Every industry group uh, belongs to a particular sector. So in that industry group, let us say there are 25 stocks. So I would like to compare my stock with the remaining 24 stocks. That will tell me whether my stock is a leader or a laggard. Okay. So when I do all these 3 comparisons, I'm not looking at the chart. I'm looking at the uh, percentage return given by the stock compared to all of these 3. That will tell me the current situation of the stock. It's like you go to a classroom of 100 students and you give them a mock test. Okay. And then when the results come, you check their marks and you give them a ranking. So if you look at the ranking, if you look at the results, you can pick any one student and see how that student is doing compared to the remaining 99 students in that classroom for that mock test. Okay. That's exactly what is happening here. I want to see strength coming into the stock. And I think MarketSmith is a good platform to do all this comparative analysis before even we look at the chart. Okay. Once I'm done with comparisons, I move to the next step, which is technicals. Now, in technicals, there are three questions we need to ask. Number one, is the stock in a stage two uptrend, which means is the price above the 50-day moving average? Is the 50-day moving average above the 150-day moving average? And is the 150-day moving average above the 200-day simple moving average? So that's the definition of a stage two uptrend. Number one, is the stock is in a stage two uptrend? Number two, is it forming a base in that uptrend? And number three, if it is forming a base, what kind of a base it is? Is it early stage like base one or base two? Is it middle stage like base number three, or is it late stage, base four, base five? As I have discussed earlier, by the time a stock goes from early stage to late stage, it has already given a triple digit return over a period of 12 to 18 months. Okay. So these are the three key considerations when it comes to technicals. And for this, we have to look at the chart. Okay. I prefer technicals more than I prefer fundamentals, because if the fundamentals of a company are strong, but technically, if it is not set up properly, I'm not going to buy the stock. Next is fundamentals. Fundamentals, we look at only three things: sales, margins, and earnings. Even earnings are not important. If the sales of a company are expanding rapidly, okay, and the margins are also simultaneously expanding, it's very obvious that the earnings are going to explode, because sales multiplied by margins is nothing but earnings, right? So we look at sales quarterly, annually. We look at margins over the past 5 years, over the past 10 years, how the margins are doing. Is it growing or is it declining? So let's say 10 years ago, the margin of a company was 15%, and now it is 35%. That's margin expansion. Earnings, we look at quarterly growth, annual growth. There is one more topic which I have not put here, which is return on equity. Not a very important point. William O'Neill discusses about this, but return on equity is different for different industry groups. Okay. But in general, the rule is if the return on equity is more than 17%, 1 7, the stock is likely to do well. Okay. It's one of the characteristics of the growth stocks of the past before they began their huge bull run. Okay. So comparisons, that is step one. Technicals, fundamentals. Once I do all this analysis, then I am ready to buy the stock. And if it is a properly formed base, I have a proper buy point, which is very precise. So something like 725.05 rupees. Okay. It's that precise, up to two decimals. I know the exact price at which I want to buy the stock. Okay. So once I decide the exact buy point, okay, I mark that buy point with a yellow line on my chart. So my next step, fourth step, is position sizing. So let's say I put 1% of my portfolio in a stock and the stock doubles in 3 months. So the stock has given 100% return in 3 months. But how much did I make? I made only 1% because my position size was small. Okay. So trading is a game of position sizing and risk management. The best traders in the world are not doing anything different from what you are doing. The only thing that they are doing well is they are taking huge positions and managing their risk properly. What does position size depend on? Well, it depends on your realized gain. So if in your previous 5 to 10 trades, if you made good money, then on your 11th trade, you could take a bigger position size, because you can use those realized gains to finance your future trades. However, if in the past 5 to 10 trades, if majority of your trades have uh, given you losses, or you don't have a realized gain, then you cannot take a huge position size on your 11th trade. So you have to be dynamic. You have to be flexible. You can't take the same position size on every single trade. You could play around with your realized gains. If you have made huge money in a stock just recently and you sold it, that increases your risk tolerance level. Second is risk appetite. See, some people are naturally conservative. Like, for example, in my case, I am a naturally conservative personality. I look at what my needs are, and based on that, I decide my position size. I am not a person who would take a very huge position size. So, naturally, in my life, if I am not a very adventurous person, so even in the stock market, I am not going to get involved in uh, adventures where I go with a huge position size. Okay, there are people who who like to have adventures in life. Those are the kind of people where the risk appetite is large. They would not hesitate putting a huge amount of portfolio in a stock. So your personality determines what position sizing you should take. But that does not mean that you forget about risk management. No matter what position size you take, you have to control your risk. Next is personal situation. This is important. Imagine two traders. One is 25 years old and one is 75 years old. Who do you think can take more? Who do you think can take a bigger position size? Obviously, the 25-year-old guy, he has an entire life ahead of him to earn money from his business or from his salary or things like that. So he can afford to take more risk. But imagine a 75-year-old guy who has retired and he's managing his retirement portfolio. He cannot put one quarter of his portfolio in a single stock. What if the stock breaks down with a downside gap, and wipe out like 10-20% of his capital? That is not a good situation for a 75-year-old person. So position sizing also depends on your personal situation. Okay, and age is just one factor. There could be multiple other factors. So, for example, the more children you have, the more ongoing expense you have. So, you have to be conservative with your portfolio. Or some weird situation like you are going through a divorce or something like that. So that situation is going to determine what position size you are going to take. Next is risk management. So now you looked at comparisons, you looked at technicals, you looked at fundamentals, you have decided the exact buy point. You have also decided the position size that you want to take. Minimum, I would recommend 5% position size, and maximum is 25%. All along that spectrum, you have to manage your risk. What is risk management? Where? Well, I want to decide where do I want to keep my stop loss before even I enter the trade, right? William O'Neill and Mark Minervini recommend a 7 to 8% stop loss, which is like an emergency stop loss, but they also recommend cutting your position sooner than it reaches your stop loss so that you cut your losses short. So even if your win rate or even if your batting average is small, you still end up making profits because the stocks on which you make money, you give them the time to go up, but the stocks on which you're losing money, you don't give it time to reach your stop loss. That's a good strategy. That is called risk management. That is called controlling your risk. So stop loss is one consideration. Number two, average gain. You look at all your past winners. Let's say you look at past 25 winners you have, and you find out the average gain in percentage terms you made on those 25 stocks. Let's say your average gain is 15%, 15%. And now you have a stock on which you are already making 25% unrealized gain. So if you sell the stock, what does that do to your average gain? It increases your average gain. So we should strive to increase our average gain per trade. Similarly, average loss per trade. If I look at my past 20 trades where I made a loss and I average all the losses, I would get an average loss number like 3% to 5%. Now, if I'm holding on to a stock, okay, which is already sitting at 7% loss and I still haven't sold the stock. Now, if I sell the stock, what will that do to my average loss? It will worsen my average loss. But imagine I hold a stock and it's down 1%. And if I sell, what will that do to my average loss? It will reduce my average loss. So the goal is to maximize the average gain per trade. And another goal is to minimize the average loss per trade. So that cushion, that margin that you earn, that's your business margin because trading is a business. Okay. And there are two ways to control risk. Number one, position sizing. So if the stock starts to come down, you immediately start reducing the number of shares you have quickly with market orders. So you're controlling your risk by reducing your position size. Number two, moving your stop loss up as the stock starts to move in your direction. Okay, those are the two best ways. My favorite way is to reduce the position size. Next, trade execution. Trade execution is an extremely important concept. Number one, once you decide that you want to buy a stock, let's say you want to buy a stock at 100. So you have to place an alert either at 100 or 98 or 99. Okay, so that when the price hits that level, you get alerted on your mobile phone or on your laptop or something like that, so that you can quickly come to your desk and check the price and volume action on a lower time frames, let's say 15 minutes, 30 minutes, or the 1 hour chart. Okay, if you see good volume coming in, if you see good price action coming into the stock, we can place a market order. Okay, that's order placement. And timing is extremely important. Let's say I want to buy a stock at 100. I don't want to buy an extended stock. So if my buying price is 100, and by the time I reach my laptop, this price has already shot up to 105, that now becomes an extended stock because it's 5% above my buy point. Mark Minervini says that he never buys a stock which is extended more than 1% from his buy price. So if he wants to buy a stock at 100, so 101 is the maximum price that he will pay to buy the stock. So what I will normally do is I will draw a yellow line at 100, and then I will draw another yellow line at 101, and then on the daily time frame. And then when I go to the 15-minute chart, I see two yellow lines, and as the price is trading inside the two yellow lines, I can immediately start accumulating shares. So if I want to buy, let's say, 1,000 shares of a company, and the price starts to go inside those two yellow lines, I would first buy 500, then I would buy another 100, then I would buy another 100 as I see more volume and price action. And all of this happens in a matter of 1 or 2 minutes as I see more volume and price coming in. But if I buy the first 500 shares and I see the price going down, volume going up, but the price going down, that's a sign of supply. So I would not add another 500. So it all depends on what the market is doing. Is the market validating my opinion? See, because if you look at step one, which is comparison, step two, technical, step three, fundamental, step four, position sizing, step five, risk management. If you look at all these 5 steps, the culmination or the conclusion of these 5 steps is that I am forming a view, I am forming an opinion on a stock, but it is still an opinion. We still have to go to step number 6 to see whether the market is actually confirming our opinion. Is it really going up on high volume? Is there a high volume breakout? So that timing is extremely important. If the market confirms your opinion, only then you take an entry into the stock. Sometimes, if I'm not available in front of my desk and I really like a particular stock, I might put an automatic buy order, right? That can also help. But in that case, your position size has to be small, because if you, let's say, take a huge position size of 20% with the automatic buy order, the stock might just touch your buy price, fill your order, and then fall 8% on the same day, resulting in a loss of 1.6% on your entire portfolio, which is a disaster to have in one particular day. So that is not recommended. So if you're going in with an automatic buy order, you have to be careful. Go in with a small position size. And the last step is trade management. Trade management is where trading actually becomes an art than a science. Till step number 6, it was all science, it was all mechanical. Okay. This is where it becomes an art, because selling is a very tricky topic. If a stock goes up 25%, what do you do? Do you sell all shares? Do you sell 50% of your shares? Do you sell 25% of your shares? Do you choose to do nothing? Do you choose to move your stop loss up or down? So there are multiple options that open up for you when the stock begins to go in your favor. How do you decide which option to choose? And you have to choose one of these options on a daily basis. Okay, so it's a complex decision to sell. So there are ways of selling which I discuss in my video course and my YouTube videos. So there are different strategies which we use for selling. Then scaling in. Scaling in means pyramiding. As the stock keeps forming multiple bases, you take entry into uh, each of those bases as the stock is coming out of that base. Selling out means Scaling out means partially selling. As the stock goes up, you have 1,000 shares, you sell 500, then you sell another 200 when it goes up more, then you sell another 200 stocks, then you sell another 100 stocks. So as the stock continues to go up, your position size keeps on decreasing because you want to book the profits. The profits are just not on paper, they actually come into your account. So these are the 7 steps of a particular trading process. Now, you tell me, if you follow this systematic process, will that not lead to an improvement in your trading performance? This is not gambling. This is not some guessing work. You are doing proper analysis. You are applying science, little bit of science, little bit of art in your trading. And imagine doing this continuously for 1 year, 2 year, 3 years, 5 years, 10 years. Imagine how expert you will become in each of these topics. Okay, that is why people like Mark Minervini, David Ryan, they may not be using the exact 7 step process, but if you look at what they do, more or less 99% it will match this particular model. So, first compare your stock with all other stocks in the Indian stock market, with the general market index, with group stocks. Then look at the technicals and fundamentals of the stock, decide a proper buy point, determine what is your position size before you buy the stock, determine where you will get out if the stock goes against you, which is a part of risk management, execute the trade properly, don't buy an extended stock, and then manage the trade well with sound logic and rules, not based on feelings. Okay, if you follow this 7 step process, will it not improve your trading performance over a period of time? Okay, so this, it's a model that I have created to simplify exactly what I do. Okay. And if you follow this process, it will help you. This is suitable for a simple breakout trading system in growth stocks, whether it is swing trading, position trading, doesn't matter. But this model is applicable for breakout trading system. So I hope this video has added value to your trading journey. If yes, then please support this YouTube channel. Please like, comment, and share this video with your friends, family, and business associates. Let us create a community where people come together with a common goal and learn as much as we can. So please support this YouTube channel, share this video so that this video reaches those people who genuinely want to become professional stock market traders. Okay. Thank you so much. Thank you so much for your time. I will see you in the next video.